Hello, everyone. My name is Nikki Young, and I'm a financial advisor and tax planning certified professional with Northwest Financial Advisors, a wholly owned subsidiary of Northwest Federal Credit Union. One of the most common questions I hear from investors, especially around tax season, is why am I paying taxes if I didn't sell anything? And so, as we just wrapped tax season for last year, 2025, it's a question that may or may not still be top of mind depending on your tax results. But it is a great question, and the answer isn't always obvious as to why that happens. So, in the next few minutes, I'm going to break this down in hopefully a very simple way so you understand what's going on and what it might mean for you. A quick compliance slide before we begin. The information contained in this presentation is for educational purposes only and not intended to be a substitute for specific individualized advice. For guidance specific to your unique situation, we do recommend that you consult with an advisor. So why does this matter? It matters for a couple of reasons. The first and foremost, it can help avoid sticker shock that happens when we get a surprise tax bill that doesn't align with what we were expecting. And when we understand where our taxes are being generated from, we can make more informed decisions about how your investments are structured, especially in taxable accounts. And then ultimately, it moves your planning beyond looking at simply what your portfolio earns, but how you can retain more of those earnings on an after-tax basis. And before I move on, I do want to make one important clarification. This conversation only applies to taxable investment accounts. So that's going to be things like brokerage accounts, individual TOD accounts, or joint investment accounts. Retirement accounts like IRAs, 401ks, other employer plans are in a class of their own. And are governed by their own set of tax rules. So what we're talking about today is where taxes may show up outside of retirement accounts. So investments generally generate income in three ways. You've got interest, dividends, and then capital gains. So interest is taxed like ordinary income or like a paycheck. Usually it can be at higher tax rates. Examples of that is going to include things like high yield savings accounts, money market mutual funds, or even CDs or certificates of deposit that you may have from your financial institution. Dividends are classified as either qualified or non-qualified, with the qualified dividends are being eligible or qualified, if you will, to be taxed at lower tax rates than those ordinary income rates. And then capital gains will either be short-term or long-term. Long-term is 1 year or longer, and the long-term gains also qualify to be taxed at lower capital gains rates. So most investors do understand that capital gains comes from selling an investment, and you can sell it either at a profit or you can sell it at a loss. But when you sell an investment that has made money, you pay taxes on those earnings. But the thing is that sometimes the gains show up even when you don't personally sell anything. And so that's what I'm going to unpack next. So I call it the aha moment. And it's when you haven't sold anything and you still get a capital gain and then the tax bill that comes along with it. A lot of investors own mutual funds. They are pools of investments, a great way to have diversification. And inside the mutual fund, the manager is buying and selling the stocks, if you will, if you've got a stock mutual fund throughout the year. And so they may be selling at a gain. And when those gains are realized inside the fund, what happens is those gains are passed through to you as the shareholders. And that is a key point. So even if you don't sell anything personally, you can still receive a taxable gain distribution. And that's where a lot of the confusion comes from. On this slide, I have an example of an investor putting 100,000 in a mutual fund. That fund declares a 10% capital gain distribution. The investor gets that $10,000. They haven't sold anything, but then they get the tax bill also. And that reduces, of course, the size of the after-tax value of the investment. And why mutual funds distribute capital gains is that the portfolio manager is buying and selling inside the fund, and it's not based on our decisions as investor. The portfolio manager is making those decisions about what activity should happen within the fund. And then by law, the gains, if there are any, they have to be distributed back to the shareholders. They can't retain those gains at the fund level. And then the last point is that the timing is not in our control as investors. The timing is typically driven by the fund. However, many of these distributions show up later in the year after the fund has completed all of its trading activity. So you may not see much income all year, and then the mutual fund itself could even, be down for the year. But then about mid-December, there goes those capital gains distributions, and then they get reported, and you file them with your taxes and pay any of the associated taxes that come along with that. So there is opportunity here, and it doesn't mean that mutual funds are bad investments. They actually have the potential to be excellent investments depending on your goals and overall strategy. But I think it does highlight something important is that how an investment is structured can impact how and when taxes occur. Because eventually somebody's going to pay the tax. But if we're able to structure our investments in a way that puts us in the driver's seat as much as possible on when that happens, we've got a lot more flexibility with our planning. And so some types of investments like ETFs are designed in a way that can be more tax efficient. Again, it doesn't mean that one is always better than the other. It just means that there are a variety of tools available, and understanding those differences can help you be more intentional about your overall strategy. So one area that has been growing in popularity that I did want to highlight is the active ETF. And the active ETF combines the professional management like you would get with a mutual fund, wrapped in a structure that can often be more tax efficient. Again, not advocating to replace everything or even anything, but to bring awareness of having more options, especially as the investment sphere continues to expand and new ways to invest come to light. So depending on your goals, risk tolerance, and your tax situation, there may be opportunities to structure a portfolio in a more tax-aware way over time. So a good question for investors to ask is, how tax efficient is my portfolio? Because it is not just about the performance, it's about how much of that performance you actually keep after taxes. And for many people, this isn't something that they've looked at closely before, but I believe that it's a great way to make sure that your portfolio is working in the best way that it can, so that way you're achieving your objectives, not only on a pre-tax basis, but on an after-tax basis as well. So the goal for today was simply to help you understand why taxes can show up even when you didn't sell anything. For some investors, it leads to better planning. For others, it could just simply reduce the surprise at tax time. Nobody likes to get a bill that they weren't expecting. And so if you understand what your capital gains overview is going to look like for any given year, you'll be expecting what happens when you go ahead and file those taxes. So if you would like to continue the conversation and look at how tax efficient your portfolio is specifically, you're welcome to schedule a consultation using the QR code on the screen. I'd be happy to take a look and walk through it with you. So thank you very much.